Welcome to the Gray Report. If you're a multifamily investor, active or passive, you are in the right spot. Or if you're just working in the multifamily industry, trying to make sense of kind of where we are today, we've got a really special episode. A friend of the show, Carl Whitaker, the chief economist from RealPage, is joining us today to break down where we've been in the multifamily market and where we might be going. There's a lot of uncertainty, but also a lot of promises for future years, potentially some better times, but it all seems relatively dark and cloudy and uncertain as we sit here in 2025. All right, well, without further ado, let's get into this episode. You're going to want to stick around for the entire episode. Make sure you subscribe to the Gray Capital YouTube channel and leave your comments down below. We'll get back to you as soon as we can. All right, let's get into it. All right, welcome back to the Gray Report. Carl Whitaker is back with us again. Carl is the chief economist at RealPage. Carl, how are you doing today?
Good, doing good. Thanks for asking, and appreciate you having us back on. It's always a pleasure to be on here. Y'all's content is one of my favorite that I kind of passively keep up with over the course of the week. So appreciate getting a chance to be a guest this time.
Well, I appreciate you saying that, but likewise, I think you're one of our favorite person to follow in kind of the multifamily economist sphere. Your post on LinkedIn or something that we track all the time. Anytime there's a new Carl Whitaker post, Matt and I are definitely talking about it, and there's conversations around the office, and without a doubt, definitely making an impact in the broader industry because it's a pretty small world of folks, and I'd be curious, I guess, on your opinion of the landscape of specific, I guess, housing economists and multifamily focus economists. And maybe we'll just start there because I wanted to ask about your team and the methodologies. But how big is the world of housing economics and specifically multifamily? How big is the universe in your peer set?
It's funny because in a sense, it's really small. You touched on it there that it is a small world, like the same people you come across regularly, whether it be at conferences or, I'm sure on your side of the equation, you'll be bidding for an asset and like, oh, these guys again, I've seen them come up a time or two before, which obviously I can't comment as much on that just because I'm not as involved in that side of the industry. But I think if you take a step back and look at multifamily housing overall, it's actually a big industry, and I mean, we don't have to get into exact numbers here, but call it 40 some odd million rental units nationally. Call it 40% of that is multifamily housing in some shape, form, or fashion. I mean, it's a big industry, but what's interesting about it is how fragmented it is. So many different ownership groups and so many people have a piece of the proverbial pie here. And compared to other industries of similar size, I mean, it's really rare to find a segment of, it's really rare to find something this large and pervasive across the country that's as fragmented as it is, which we actually think is a good thing that it's fragmented, but it's just kind of interesting to observe it.
It is fascinating. I'm thinking back, and especially last year, and still right now today, when we look at trying to forecast generally where the economy is going, which everyone is trying to do, and no one is doing a great job at it, even the best in the world in the industry. But how big a role housing plays, when we're just looking at CPI and breaking down shelter as a component, it's 34% of the overall CPI picture. So it's it's a huge part of the economy. Yet there are so few people that are solely focused on that area of the economy. Did you feel like, and do you feel like, I guess, that you have a little bit of an inside track of kind of some of those leading indicators, and we're talking some of the more macro issues? Because when it comes down to, okay, well, shelter is going to be driving CPI, and CPI is going to be driving interest rate decisions and other decisions. I guess describe just kind of that feeling of a little bit more of kind of that inside track, being closer to housing.
Yeah. Well, I wish I had even more of an inside track, because it would just be great to know like the true leading indicators, and to have the true crystal ball.
But but you have the nuance, I guess, is more of what I'm saying in housing
Sure.
relative to just looking at it from a broad, just, line item as a component of something broader.
Yeah, absolutely. And it's interesting you mentioned that too, because I think we've seen the importance. We've always known the importance of housing as it relates to the broader economy. But as you point out, with shelter being 1/3 of CPI, for example, CPI kind of took the headlines for the past 2 years when it came to economic themes and trends. So the fact that housing comprises 1/3 of that, we really saw housing take center stage in terms of its importance, and being a key driver of the broader national economic landscape. And I'm sure we'll talk about this a little bit later, but I kind of joked with some colleagues here over the past couple of years that truthfully, our job as housing economists before 2020 was actually pretty easy and pretty straightforward. I've used this analogy before, that it kind of felt like being the weatherman in San Diego. That's a pretty easy forecast to nail. Past couple of years, it's been a lot more volatile. There's been big ups and big downs, and some black swan, or maybe not black swan, but you see these things that you didn't expect to come in, or some expected influence. And I'll touch on this later too. Some expected influence like job growth that historically was like the end all be all metric of predicting demand and rent growth. Now even that relationship has broken down to where it's not as powerful. And these are just, the world that we live in. It's just we're seeing changes happen in real time in an industry that isn't quick to change always.
It is really fascinating of some of those indicators or those metrics that at some point play a different role, or maybe a different weighting than they do today. Can you talk a little bit more about that of, I guess the before times before COVID, and the easy weather, it's 3% rent growth a year, and it, obviously checking for major changes, but relatively the same. And then COVID happens, and it's an explosion in data moving every which way. There's gaps in data, some things were stopped reporting. There are base effects, lagging indicators. How have you and the RealPage team, I guess, looked at how you're examining the data, how you're weighting different variables, and I'm sure it's still evolving, because we're still kind of getting over this supply hump and supply wave. You're curious on the methodologies, how they've changed over time, and if you all have, I guess, learned anything over the last few years.
Yeah, absolutely. And I'll give a quick shout out to our data science team, who's far smarter at this than I am. And, they're able to really crank through these equations and weightings, but it largely falls upon us to be the interpreters of this data. And, hey, it's great. If you go to an investment committee and you're talking about multicollinearity and R squares and, fit of regression, the eyes are going to glaze over. It really comes onto our purview to say, like, hey, here's why these variables matter. Here's why this investment is a good thing, or why you should actually look somewhere else as maybe a better alternative investment. So I think I would say some of the biggest things that have changed in the data realm the past couple of years are, one, this idea that job growth historically was a good predictor. That's not to say that it's not true today, but job growth, there was always this rule of thumb pre-COVID that for every 5 jobs created, that would equal 1 household formed. I'm sure that there was probably always holes to be poked in that theory, but today that relationship just isn't as strong, because the way the BLS captures job growth data, for example, if you're working remote, let's say I'm working remote and I sign on with Gray Capital there, does that job get created in Indianapolis, or does it get created in Dallas where I'm at? Well, the household being formed is going to matter based on where that job was created. We've seen a lot more importance on or a lot more weighting towards migration has been a big key indicator. And again, I think this kind of goes hand in hand with that remote work phenomenon. You can work from Austin, or you can live in Austin, but technically be counted as a San Francisco company employee. So migration has been a big focus. And I think one final component that we've always known has mattered is supply. But I think because we haven't seen this degree of supply in the industry in quite literally 4+ decades, and some markets have literally never seen this much supply, we never really fully understood at the onset of the supply wave how to test the impact of what that supply would do to the markets. If you've never seen this phenomenon to a certain degree before, how can your models fully understand and predict the future? But what we have seen is that our models have done a good job of assuming and estimating the demand side of the equation. And as you know, supply and demand don't work in vacuums; they work together. So the supply side of the phenomenon has been kind of the tricky part, really, to get in front of, just in terms of assessing the impact of a once in a lifetime wave of supply. So those are some of the ways that it's changed, and I'm sure that there's some other ways too, but those are some of the big changes we've seen.
Yeah, I mean, it makes a lot of sense, predicting supply. I mean, you can look at some of those metrics like, population growth, migration growth, employment growth, that makes sense, that you would think that would be indicators of future supply. But then there are other variables that at different levels seem to truly impact that in ways that at lower levels might not. For example, the availability of capital, whether it's debt or equity capital. I mean, you can have the great demographics, but if there's no debt or equity for those projects, as we're seeing today, there's much less, equity available for new development. You can have a growing market like, Austin, Texas, or, Nashville. But, with positive demographics, take the current supply out. But, if there's not the financing to go invest in those markets, it's going to be incredibly difficult. So, I guess, you were mentioning how you're often, I guess, translating from kind of like the research side, the statistical analysis, to then, the investor who is like, hey, I understand how to calculate a cap rate. It's nice and easy, but like that's as sophisticated as I get. What are some of the challenges, and do you ever feel, I guess, like somewhat limited in terms of maybe not dumbing down, but like kind of making sure that simplifying the analysis in a way? Is there ever, I guess, a desire to go a little bit more deep, but it's just not going to translate well? It's just not going to get the coverage that you might like to see?
Yeah, trying to find that balance is tricky. Now, I'll be fully transparent here, and I thought this might be the only audience that's ever heard this. I'll be fully transparent that the only C I made in college was in statistics. So, at the time, I thought, wow, statistics is going to be a career path that I'm like going to have nothing to do with. I went to school for education, as I've shared in previous webcasts or previous podcasts. But what I've actually found as my career has gone on is that being a C student in statistics has actually been as much of a blessing as it was a curse, because I myself need statistical concepts broken down extremely simplistically.
Yeah.
And for me, it's somewhat cliche, but for me to explain to somebody else what these things mean, I first have to understand it. And for me to understand it has to be very simplistic. So there is at times this, want to dig a level deeper, but I think we've been able to find that decent balance. I think the bigger challenge is, we cover so many markets nationally. Real estate is inherently a local phenomenon. We cover these national themes. Most of the time we'll have somebody push back and say, hey, that's great, but my market isn't seeing X, Y, Z. And that person's perspective is true because that market is marching differently. So I think the bigger challenge is trying to marry up national trends to local trends, staying local enough that it matters for the audience, but not so local that you alienate other groups that aren't active in whatever region or whatever even asset type they are active with.
Yeah, it is a huge challenge. I mean, there's so many markets. Every market is different. And then, within those markets, there's different submarkets can have completely different dynamics. And there's only so many hours in the day. And there's only so much interest in some of those markets also, but they're important to the folks that are investing or interested. How, I guess, are you using, I guess, any AI tools to try to, I guess, expand kind of like the bandwidth of the team, and what does, I guess, the RealPage team look like that's doing that work? Because that's a lot of work to do. It's a lot of volume of information to analyze.
Yeah, it is a lot of volume of information. So kudos to RealPage, that's long been AI machine learning friendly. In fact, our forecasting dashboard, I won't go into a ton of depth here, but our forecasting dashboard or the forecasting methodology since the mid 2010s has used machine learning. So we've been kind of ahead of the curve in this way, or in this manner, in some regards. I think to understand how RealPage does all this, you kind of have to see what the organizational structure looks like and where our team of economists fits in. So taking a quick step back, our team of economists and analysts, our job is largely to, take the data, carve a story and say, hey, here's what the data suggests is happening both nationally and at a market level, whether that be in written reports, whether that be in discussions, presentations, conferences. Our job is really to kind of translate the data from just nebulous data into some sort of coherent story. To do that, we lean heavily on our data science team, who's actually, getting all the data out of our databases and marrying it up, making sure that this matches, that this is, a sound methodology, so that we're not reporting on something that it's like, well, if the methodology wasn't sound, you're really just, there's nothing to report here that's newsworthy. So we lean heavily on our data science team. We also lean pretty closely on our account management team, where we work closely with, who by proxy of working with these clients, we kind of get an idea of what we should be looking at. If we get 2 or 3 questions that says, hey, what's happening with XYZ, or what's happening in this market, once you start hearing a question enough, it tells you, hey, there's a thread that we need to start pulling here. So I like that we're able to navigate both sides of that equation. But as you mentioned, it's just it's tough because you're spreading yourself thin in some ways. And we can't pretend. And I always say this when I go into an investor summit or a board meeting. I'm like, look, everything I share is going to be very macro. I can't pretend to know more about y'all's properties and y'all's neighborhoods than y'all do. I'm not even going to try to pretend like I do. Hopefully what I'm sharing is going to provide the context that says, oh, okay, this is what's happening, brewing in the background. Here's an impartial third party that is looking at this market, not through the lens of our street corner, but through the lens of someone who's less familiar with the area, and maybe they can give us a more unbiased perspective. So I'm in some ways actually kind of glad that we miss the super, super, super local nuance. There's a place for that, but sometimes you miss the forest for the trees too, and that's where you want to provide a certain level of scope and analysis, but also give way to the folks that are on site, that are local asset managers, et cetera, who are going to know more about their individual property than we could ever pretend to know.
Yeah. It is, as often as I see national trends, sometimes not following some of those, hyper local trends, it also can be, I found it fascinating, if some of those national trends do, line up with what is going on, kind of boots in the ground, at the property level, whether that is, and just as an example, some of the traffic data and demand data for April, which wasn't bad, but it was a little bit lighter than it was in March. And, typically, we're in peak leasing season, typically, April from June. You had a post on LinkedIn that, that basically pointed out that, 55% of, the growth at a property typically takes place during that period, April to June. And usually from that period, it's like a step up of increase in demand until, June, and then July, depending on the market, it either peaks or starts declining as, everyone's trying to, moved in before school starts in August. When I saw the April numbers coming back a little bit weaker, first I saw it in our own portfolio, in that we just had a slight decrease. It wasn't a full drop off, but it was a slight decrease in traffic comparing April to March. And then when I started seeing some of the national data, I started seeing some of those same metrics. Does that seem like that sentiment right now? I'm just curious if you have any thoughts on, why that would be, because, demand has been strong. We're getting over a lot of these supply waves. But when I asked myself, what was going on in April? Well, we had, Liberation Day tariffs and, general kind of economic uncertainty. And as wild as it seems that renters may be holding off on decision based on kind of macroeconomic, questions, like tariffs, we saw in the pandemic as well, when there was uncertainty, there was less traffic and people, stopped making some of those large financial decisions. So I'm curious if you have any, it's just happened, but I'm just curious if you have any takes on kind of where we are so far in 2025 in terms of demand.
Yeah, of course. And actually, real quick, I'll call back to something we were talking about earlier about data points that matter more today than they did historically. I think
Yeah.
sentiment is a really good example where sentiment's always mattered, but calling a spade, we live in a connected world more so than we ever have before. And I really think that connectivity, that, just the frequency and the inundation of news, whether good or bad, plays a role psychologically on how we behave. And, economics is as much behavioral as it is anything else. So sentiment's a good example. And I do think, getting now to the question, I do think declining sentiment resulted in a softer April than many expected. I haven't seen the May stats yet. We're 20 days through
Yeah.
May. So I'll be curious to see what May yields. But I think sentiment there's a lot of let's wait and see happening among renters. I do also think too, though, that especially over the past couple years, we've seen that it's becoming less frequent. I won't say less common because it's still the most common lease term, but it's becoming less frequent that renters will sign the traditional 12-month lease term. Operators are saying, hey, if you want to sign a 13-month lease term, then you'll actually get a little bit of a discount on your rent. It'll prorate a concession that's being offered perhaps, so it's a little bit easier for the property to absorb. But nevertheless, the fact of the matter is we've kind of seen a disruption in that typical seasonality. Where, to your point, April through June is still the peak, but it's less of a peak than it was many years ago. I think the one thing that would, however, lead me to say that April was probably a little bit softer than some expected was that occupancy went up. And rent growth also went up on a month-over-month basis. That is, occupancy went up, but rent growth didn't go up as much as you would think based on that occupancy increase. My interpretation of that is that operators are being a little bit more conservative in their approach to the market. We're going to take a bird in the hand is worth two in the bush approach. I don't know if this renter will be a lead tomorrow. Not to mention the renters have a lot of availability or a lot of options to choose from. So if you get a good quality lead, rather than risk losing that lead to the property next door that's offering a concession, you're just saying like, hey, we're happy to have you here. Let's get you in the unit. And we'll forego a little bit of rent growth simply because it's a little bit more of a conservative approach to the market. Again, largely fueled by the background economic noise.
And I know some of that, the evolution of the market and kind of the disruption of seasonality, some of that has to do some of the the processes and systems that folks are using to lease apartments. Like RealPage, has several products. The AIRM product that we're actually starting to use here at Gray Capital and our properties managed by Gray Residential that basically allows to kind of amortize that the cost of those vacant units and allowing renters to essentially kind of choose their move-in date and their lease term to kind of optimize for a price. And that'll be really interesting, as that continues to roll out in different markets and other operators starting to utilize that. I'm curious, in a world, if we could imagine, I guess if sentiment was, relatively positive, we didn't have the uncertainty today, and if we were kind of following the incredible demand that we saw in 2024, which was essentially, like a cyclical high. You have to kind of go back to kind of just post, well, if you take out COVID, you have to kind of go back just post great financial crisis to see demand as being that high. Would we be living in a different world if there was less uncertainty? And just I'm curious in your take on what demand would look like in that hypothetical scenario.
Yeah, I think it would probably be a little bit strong. I think you would see a little bit more demand, and I'll just use for the sake of example here. Let's say you and I are living together in a roommate household. You hear this news of tariffs. You hear of some ports, where layoffs are happening. If you're related to an industry that could be affected by that, let's say our lease term is coming up. You say, well, what do you think about living together again this next year? Well, when that sentiment isn't declining or there isn't as much background noise, you might say, well, no, I think now's a good time to go, form our own households. But we're kind of in a unique situation right now where I need to find a more scientific way to explain this, but in some ways, the supply delivering is actually allowing for a release valve for demand to flow into that would otherwise be pent up. And I think this is really, there's the second layer of this is why the reason that supply actually does help housing affordability is exactly that. It allows a valve for demand to flow into. If you move into a brand new lease up, that creates a vacancy in the property you just moved out of. Even if that was a very nice 2020s build, well, then that property has to get competitive with the market. That means somebody that's living in an asset that was 10 years older moves into that spot. That person then creates a vacancy, so on and so forth. So it kind of becomes this game of musical chairs. Now, at some point, you run into a situation where properties don't necessarily have the ability to have another back channel to fill their units from. For example, a very affordable Class C property may not necessarily be able to dip into the capital A affordable segment of housing just because those properties operate differently. The mechanisms by which they get their demand is different. And what we're actually seeing now, I've kind of gone off point here, but what we're seeing now is that Class C assets are the only product type still cutting rents, having a hard time maintaining occupancy. And I think what's happening now, getting back to the question, what's happening is that a lot of the demand strength we're seeing today in some ways is actually being driven by the fact that supply is also delivering. If we didn't have this supply delivering and sentiment was dropping, that's where you run into kind of a frozen in or a locked in market. And I think that's what you see largely in the single family sector, where there's kind of this locked in effect. Inventory's tight. It's getting a little bit better availability, that is, but it's tight. Buyers aren't interested in buying today as much as they were a couple of years ago because interest rates or mortgage rates are at 6-7%. So I think that that's kind of a good example of where the market would be if not for all this supply delivering. Sentiment would be low, demand would be weaker. But now that supply is delivering, you actually see that demand is demand is matching the supply delivering.
So a lot of really interesting points there that I want to unpack. And one of them kind of reminded me, again, of another post he made recently talking about, relationship between occupancy and rents. And then often we're thinking about how, rents are driving occupancy, but often it's the other way around. Could you expand on that a little bit?
Yeah, absolutely. I think it's pretty simple. Econ 101 is that rents respond to occupancy or the quantity of a good demanded relative to how much of that good is available rather than the other way around. Now, at some point, that relationship can deteriorate, but, I use the analogy all the time of the reason eggs have got so expensive the past couple of months is because there's not enough quantity of eggs being supplied. Well, uniquely, while the quantity being supplied has dropped, the demand has risen, especially because there's kind of a scarcity effect, and that's what's driven the prices. So prices really are almost always exclusively a function of supply and demand, i.e. availability or non-availability, and apartments are no different. I think touching back on the point earlier of why April was a little bit unique was that the occupancy numbers suggested that rent growth would have moved a little bit more than it did. But I think, again, what operators are doing is being a little bit more conservative. We still know there's a lot of supply delivering. We are past peak, but it's still a lot of supply. So I think operators are taking one more kind of like, let's ride this out. Let's be a little bit more conservative in our approach to the market and then see what happens the same time next year.
Yeah, I think anecdotally, we've been observing that as well as some operators. I think even us at times, how are a little gun shy because we've been through the last 2 years and we're in the Midwest, so we've seen relatively kind of stable growth, low growth, a little bit positive here or there. Haven't seen negative, but certainly it's been slower than it was, in 2021 and even prior to COVID. And also, the population, the demographics have changed, collections and delinquency rates, have changed, and the ability to collect has become more difficult in some markets and among some, demographic groups. And I think that's, led to a little bit of hesitancy among some other operators. it'll be interesting to see when that finally turns over, as we kind of really get past the supply wave, we get to a little bit of normalization. And just as though some operators, I think, were behind the ball a little bit, back in 2021 when we started seeing a lot of rent growth, but having to transition from a period of we didn't know if anyone was going to pay rent to all of a sudden everything is 99% occupied. Getting to this piece, for the relationship of supply and demand, the concept of kind of like building it and they will come. I think you were kind of alluding to that a little bit of how kind of that new supply can then allow, for that relief valve to kind of create some of that new demand. Is that what we've really experienced, especially last year as we were hitting a freeze, and we also saw, demand just surging at the same time. And I just told myself, I don't think that we would have seen that level of demand if we didn't have the new supply. But am I wrong there? Did they build it and renters showed up? Is that the story?
Yeah, I think that's largely the story. And I think if you go one level deeper, the reason that theory works is because there's just inherently an undersupply of housing nationally. There is a finite level of supply and demand that can be met. And I think some markets have seen that happen too, where, build it and they will come. Well, Austin being a good example of where, while it is true, it's just taking longer for those units to fill. And because it's taking longer for those units to fill, that's where you see rents falling 5, 6, 7% year over year for the better part of the past 12, if not 24 months at this point. So I think that's partially it. The challenge there is also, too, that there is this precedent of, you look back to 2006, 2007. Now, this was for the single family, but you see some of these markets like Phoenix that they did overbuild in terms of supply. And I think that today, for multifamily, what's a little bit different than 06, 07 was that a lot of that was speculative building. Today, It's not as speculative, and I'm sure that there's instances where it has been, and there is, of course, getting a little bit more local. There is a challenge that if you're the first property to deliver in one of these like truly ex-urban areas where like you just leveled a cornfield and put up 300 Class A units, that's a little bit riskier, but developers are also paid by absorbing some of this risk. That's part of the development model. And I'm not a developer, so I can't, opine on that in great depth. But I think the difference today is that, yes, there is this, if you build it, they will come. And largely that works because there is just an inherent undersupply of housing to meet the demographic needs of today.
So build it and they will come until you've just built way too much. And then there's just no one else to come. Like there is a limit. No, that makes sense. So again, we don't know what today's going to look like or really the rest of this year. I mean, of course, that's what I want to ask you about. But, it's almost, how does one come up with an answer? It seems like there may be a little bit more clarity, like not on the short term, but like maybe like medium, kind of long term outlook. So, I guess fast forward to 2026, it's just you and I here. No one else is gonna see this, so you can make whatever calls you want. Just what do you see? Kind of Q2, Q3, 2026. What does the multifamily landscape look like?
I think we start talking a lot less in 2026 about this brief period of oversupply. I think by 26, we're talking about an equilibrium. The following year, I think we start talking about like, hey, where did all those properties that we were building go? Because now we're not delivering nearly enough. So I think 2026 is going to be like a true transition year in terms of that narrative from oversupply to equilibrium to undersupply. I think 2026, what you're going to see is just by simple nature of averages, most markets working past their supply peak. That's going to mean that the bottom performing markets start to merge closer to their long-term norm. The quote unquote outperforming markets today, it's not necessarily that the outperforming markets are getting double digit rent growth. I think, like Buffalo and Syracuse, New York are some of the leading rent growth markets right now at 6 to maybe 7%. What's happening with the average is that the bottom performers, some of which are really big markets like Austin, Charlotte, and Dallas, are pulling down the average. So I think next year we're going to talk about the average nationally being for rent growth, for example, being closer to 2-3%, because those underperformers are going to start to lift back up closer. If not positive, then they'll be closer to zero. I think most will be in positive territory. I think whatever happens with the economy, that's obviously the big TBD. But you look at some of these background economic variables, such as like job growth, for example. The most recent jobs report came in stronger than expected. What have we heard for the past like 60 jobs reports? Most of them have come in stronger than expected.
Yeah.
Maybe 60 is a little bit exaggerating, but past 3 years, it's it seems like every headline is stronger than expected, and then every now and then you'll get one that's noisy where it's job growth underwhelms, the stock market reacts for 2 weeks, and then everything's back to normal. So I think 2026, we're going to see a much more normalized market. I guess put it this way, I think 2026 looks more like 2019 than any of the past 6 years by that point will have.
Okay, well, that makes sense. And so, but most likely we'll start to see, or many of those Sunbelt markets like Austin will be in that recovery mode, kind of finally over their peak supply and, at least maintaining, if not seeing some growth. Every market's different. Sometimes though, after a period of negative rent growth, we see a little bit a strong lift and a pretty accelerated slope of rent growth. Are those dynamics at play, or is it going to be kind of a slower rate of growth after the peak?
That's a good question. I think it'll depend. I hate saying this answer. I think it'll depend on the market. But what I've been looking at to kind of guess where that'll happen, that more pronounced increase in kind of that snapback effect, if you will. What markets look more V-shaped, which ones look U-shaped. Mm-hmm. The number one variable I've been looking at is how many units are delivering next year relative to this year, or how many units are delivering next year relative to the peak. And simple math, the markets that are furthest off that peak are going to see more of a snapback. I think this is where in Austin, I know we've kind of talked about Austin a little bit here. I think this is where in Austin may actually surprise some folks and say 2026. It's still delivering a lot of supply, but the delta between what's going to deliver next year relative to the peak is something like a 60% drop off. Well, if you have a bunch of renters in these markets that have 1 or 2 month free concessions, when those concessions burn off, that's equal a 1 month free concession prorated over a year is equal to an 8% rent growth, even if rents don't organically grow beyond that. So I think concession burn off in some of these sharply declining supply markets is going to cause a little bit more of a V shape. Those markets may not be back into the top 10 leaders, but I think that they're going to see a sharper rebound. I think the interesting one that I think is going to be worth monitoring as we get into the second half of this decade, which is kind of crazy to say that we're already halfway through the decade. But I think the Midwest is actually going to be looked at in a different light. I think, I even saw something the other day, and I apologize, I can't think of who the outlet that reported this was, but the city of Detroit recorded population growth. Not MSA, but the city of Detroit recorded population growth. That's maybe an extreme example, but I do think that there's kind of this understanding, or a little bit more positive light being shined on the Midwest. So I think that 2026 and beyond, another discussion point we're going to have is, there's a lot more people looking at the markets from the Dakotas to Ohio, south to Oklahoma than there have ever been before. And it's going to be a lot of this, partially because a lot of the stability that those markets have provided the past 5 years.
Yeah, I was going to ask you about the Midwest and the perception of markets in the Midwest, because it's gone through a change. Many Midwestern markets have been kind of the top rent growth kind of leaderboards for the last couple of years, and clearly a little bit more resilient in some way, in some metrics. But, how permanent is that? Because we're going to see the Sunbelt metros come back. I mean, the job growth, the population growth, those kind of stalwart metrics are clearly there. There's still a lot of migration, and with supply coming on back within a below norm, we're going to see some growth. But I'm always curious from an outside perspective, because I'm insulated. I'm in the Midwest, and I'm even worried that, our Midwest, propaganda has seeped into your analysis, Carl, because I remember, 8 years ago, and I've told the story a lot, but, go to NMHC and, it's Texas and Florida get, a huge period, the Sun Belt, the primary markets, and then in the Midwest, Chicago gets mentioned and, for, a minute, and then we move on. I guess, in conversations with other owners and just, generally kind of in this national conversation about multifamily, the Midwest kind of moving beyond I guess, kind of Rust Belt flyover country moniker, which has kind of had for a long period of time, into a more investable region due to stability.
I think so, and I think part of it too, it's funny you mentioned that with Chicago, because at conferences, whenever that was being brought up, really it was like a 30 to 45 second discussion point on the Midwest summarized by Chicago, which was really, hey, we're going to talk about the urban core, we're going to talk about the loop in Chicago. Yeah. Now, however, you start seeing suburban Chicago being discussed. You start seeing Columbus discussed. You start seeing Indianapolis discussed, and I think a lot of that is you're even seeing that start to filter into the conversation from things such as the CHIPS Act, for example. The CHIPS Act, the Midwest was probably going to be a net winner of that one piece of legislation. And I think that there's a couple things brewing in the background that really kind of inform a positive Midwest outlook. Now, the Midwest, I think, and actually not to over highlight the LinkedIn angle, but I actually posted something on LinkedIn last week that showed a standard deviation or volatility of market. And what was fascinating was that most Midwest markets are less volatile than the national average. Now, their peak periods are also usually below that of the national average, but the floor is also higher. So you've got a low ceiling, high floor kind of market. I liken that to bonds in our, personal investment accounts. Sure, maybe you have some shares of Tesla, and maybe, you even have a little bit of Bitcoin and crypto on the side, but that doesn't make up the core of your investment vehicle. Similar, the Midwest may not make up the core of everyone's investment vehicle, but it is going to make up a larger share today than it did it's going to make up a larger share going forward than it did historically from like the big institutional players. And I think that that's going to be when you start seeing the institutions showing interest, that's when you really know that needle has shifted into more of like hey, there's genuine interest here. And final point on that angle is just, look at what's being developed in Indy, look what's being developed in Columbus. There is still kind of that Rust Belty Midwest, not to pick on the Milwaukees and the Clevelands of the world. Yeah. But those are a little bit harder of a story to sell because they've got structural headwinds such as population, like significant population loss. They don't have like marquee employers in town. Pittsburgh could probably be thrown in there. Now, that doesn't mean that those markets can't support some investment, and somebody who's wise in their approach can absolutely find a way to make that work. But some of these markets, again, Columbus and Indy kind of being the two that come to mind most substantially, suburban Chicago as well, those are kind of going through a sort of renaissance in some ways. And I think you're going to see that inform more of the 2020s, post 2025 outlook.
Yeah, it was a great post you made on LinkedIn talking about, I think it was Odessa, Midland, Texas, and Grand Rapids. And I think you asked everybody, not to spoil the post, but to try to guess which other market has seen like the least amount of volatility. I think since I think it was at the early 2000s or so, and you gave a hint that it was in the Midwest, but it was Grand Rapids, Michigan, which not many individuals are thinking about investing in Grand Rapids. If you're in Michigan or if you're in the Midwest, maybe you are, but it doesn't necessarily make the list like some of the Sunbelt metros that are on so many investors' target lists. So that was a fascinating piece, and I'd love to see, again, I think that was an example going back to early part of our conversation about the kind of different types of analysis also. And that, that's not necessarily, looking at the standard deviation of rent growth isn't, too wonky by any means, but even that in itself isn't a metric that is covered, traditionally. It's usually this is the rent growth, or this has been the average rent growth, but that volatility isn't always a metric that is shows up in research. You also did something on the weather, traffic and temperatures recently, which I thought was really interesting, because that's something that anecdotally like makes a ton of sense, and of course is would be true, but actually putting kind of the data behind it to see lower temperatures related to traffic patterns truly makes sense, or there is a correlation. What's next, I guess, for you and RealPage? Anything big, I guess, exciting projects that you all are working on, and yeah, what should we expect from you all here in the future?
Yeah, I'm really excited. Not next week, but the following, I guess, depending on when this releases, first week of June, we're having an internal meeting just to talk about some metrics that we'd like to sink our teeth into with our data science group. And, this is just going to be a brainstorming session, just like truly sitting down, talking about what interests us. But I'm hopeful that coming out of that, we'll have some different angles and data points that we can look at and share and hopefully disseminate at some point. No promises there. This is just, again, truly a brainstorming session in the interest of sharing. So that'll be interesting on like the true data wonk side of things. We do have our annual user conference coming up here in August in Las Vegas called Real World. We'll start shifting priorities to that here pretty soon, just getting conference sessions built and, understanding the clientele that's going to be there. So that'll be a big focus, but that's something we're looking forward to coming up here in August. And then once we get into the back half of the year, starting usually around September, that's when conference season starts back up. September and October are some of the busiest months for us. A lot of groups that have their board meetings that we get asked to come and present in. My favorite thing we do, by the way, is being asked to come present in those types of meetings. So yeah, looking forward to that. But I think those are the biggest things. The other thing too is I would say that AI is here to stay. I think AI is going to be more pervasive in all walks and forms of life, and I think that that's true in the apartment space as well. And I think RealPage is doing some neat stuff there. I'm far enough removed from the product roadmap that I don't know any specifics, but I would say that AI is something that's going to be less of a fad and more of a here to stay type thing.
Yeah, it does seem like we are transitioning from the, interesting little, piece of technology to play around with to really finding some practical use cases that really can move the needle, and just understanding how useful a tool some of those AI features can be. So that's exciting. Clearly, you guys have all the data and the history of using it from back machine learning from the 2010s, and to you guys have obviously AI driven products as well, which is really exciting.
Yep.
Yeah, well, Carl, you have to come back on the show. We'd love to have you on. Everyone in the office was very excited that you were going to be here today. I know that everyone's going to be listening in. What's a good way for folks that want to kind of follow along and follow your insights? How should they follow you? And if they want to get in touch with you, what's the best way to do that?
Yeah, and I appreciate you giving us a chance to share this. And just FYI, y'all are more than welcome to reach out to me. Just feel free to send me a note. LinkedIn, just my name, Carl Whitaker. That's where I'm usually most active at. But you can also see what we're up to on our webcasts page, realpage.com/webcasts. This is where we'll have the the regional overviews. We'll have our national house view. We'll also do some different things too, where we'll do like a mid-year demographics update. Here's the demographics of the American renter, if you will. So some of those are really fun that are outside of the typical, rent growth occupancy by market. And then finally, our team of content writers and our analysts work closely together, realpage.com/analytics. That's where we post both long form blogs and our short form blogs. So kind of think of that as a shared Substack among the group, if you will.
Got it. Cool.
Where we're sharing data points and graphs, and all those are good ways to get a hold of us and stay on top of things.
Oh, wonderful. Well, again, if you are in the multifamily industry and you are not following Carl and RealPage, you can stop what you're doing and definitely give them a follow and check them out, because they're publishing just consistent, really interesting information, and should be a part of just your regular consumption of information and research. So, Carl, thanks again. We'll talk to you soon.
Perfect. Thanks.